Not everyone's in the position to invest, and I don't think it's something that you should always do immediately when you're ready to do it. But it is something that is very beneficial and something you do need to know about, because then you can make the proper decisions on whether or not you should start. So today, I'm going to be teaching you the what, the where, and the how for investing in the stock market so that you can make your money work for you. A disclaimer, I'm not actually going to tell you what to invest in. I'll be rather sharing you fundamental tools and tips so that you can make your own educated decisions with your money. So to begin, there are three fundamental things that I think every security involves for the most part. And number one is the ticker symbol. The ticker symbol represents, or it's an identifier for most securities on the stock market. It's a combination code of letters and numbers, and it identifies what security you're looking at. The next is going to be expense ratios. Now, these are the con for holding onto certain securities. They will be a percent shown, and they will basically eat away at each share you have based off that percent. The next is going to be dividend yields, and this is the pro for holding on to many securities. These dividends will be paid out over the course of a year, and the rate of which depends on the dividend, but it's basically just free money for holding on to that share. Now, I will say that you shouldn't blindly follow either of these two because they might represent different factors of a security, whether or not the health or longevity of a certain security. So you must pay attention because you can potentially live off of these earnings if you know what to invest in. So stocks are your singular companies, your Microsoft, Costco, Apple, etc. And crypto is your digital currency, your backed by a high security and then also even higher demand usually. These can be extremely volatile, so be very careful with these. Next are REITs, and this allows you to invest in the real estate market by investing in companies that buy land. And not only are these great because you're investing in the real estate market, I mean, come on, but you're also usually being paid higher dividend yields. Next up are bonds, and they differ from the previous three because you're not actually buying any part of the company. You're lending money to either governments or corporations in exchange for a steady stream of payments over the course of the bond's maturity, which usually lasts 1 to 30 years. And because bonds can last so long, they're usually pretty sensitive to interest rates and specifically the changes of those interest rates. When you hear about bonds, you'll hear that they are really good for securing your money. And that is because they work on the inverse of stocks. Whereas if the market's doing really bad, existing bonds actually do really well because they become more valuable compared to the bonds that are being issued currently. And so as you age, most people recommend that you start switching out certain investments into bonds for security. Because security is everything. And a good way that you can secure your earnings is by matching the market. And that is where index funds come in. So index funds are investment vehicles that track or mirror sectors of the market. And specifically, these are market indexes, your S&P 500. And there are many more different lists of index funds, or rather market indexes, but there's just too many to list out. Mainly how you'll find these indexes listed is as either ETFs or mutual funds. And how these are represented are ETFs are passively managed, so usually they come with cheaper expense ratios. They're more flexible with your investment. You don't have a minimum investment balance, and they also are traded throughout the day, just like stocks. Whereas mutual funds are traded once per day, they're actively managed, and they usually have higher expense ratios. So you kind of got to pick your poison because there's no really surefire way to invest. If someone says that, they're just incorrect. You just saw how many different securities you can invest in. And there's just as many ways to invest in them. It's because the routes that you take when investing can determine everything. Them being an active, passive, or hybrid approach. So with active, you're frequently buying and selling stocks and shares throughout the course of months. And this takes research, it takes dedication, and it takes intense focus when deciding what to do. And you have your active trading, your day trading, things like that. But you also have things called covered calls. And covered calls are where you sell you offer up the ability to buy the shares that you hold in exchange for a premium. And you do this because you pocket the premium, and if the price that you set for those shares isn't met, you keep the shares too. So you basically sell the possibility of losing your shares and you're paid for it in return. On the other side of things, you have your passive way of investing, which is mainly just investing in index funds over the course for matching the market. You're not doing much, you're holding stocks and shares over the long term. And many people also take this a step further and do autonomous investing, which is where you are actually able to set up automatic payments from your bank account to your brokerage, and then from your brokerage to the certain shares or securities that you want to invest in. And this is really beneficial, not only because over the long term, the market usually always rises, but you also are guaranteed to unlock compounding interest. And what compounding interest is, your money builds on itself consistently, and eventually it just grows to enormous size. And so with reinvesting in autonomy, you can invest weekly in small dosages and really take advantage of that compounding interest. And then of course, a hybrid approach, it's a little this and a little that. It depends on your own personality of what your split may be, whether it's a 20-80, 40-60, it doesn't matter. And of course, you can take this to different degrees and also in different mediums. But of course, how are you supposed to know really where to even put your money? Because it's one thing to know your options, but it's another thing to know how to find new ones. And that's where the different tools that you use to invest become even more important. So first, you'll need a financial news and data platform. There are so many out there. I use Yahoo Finance or NASDAQ.com or something like that. Those are really great. There are a bunch of others. I know there's like a Bloomberg one and things like that, but you need those platforms in order to find information about the specific securities that you want to invest in. That's how you're going to find all the information you need to make proper decisions on whether or not you want to invest or not. The next would be a compounding interest calculator, and that is going to be your investor.gov. That basically you put in separate variables and it conducts a calculation on whether or not what your return is going to be over the long term based on different variables. And then to follow that, you have your tools on finding your information, but how do you find your unknown unknowns? And that's where I think using AI as your research assistant can be very beneficial. So I would say that using general AI like Copilot or Gemini for just basic searches and simple calculations, just to find information to really get your mind straight about what you're going to invest in. But if you want a more complex search, there's a free AI called Perplexity.ai that provides sources. It searches the web in live time. It's a structured response, and that is super beneficial to use as well. And then if you want information on what sort of external factors affect you as an individual, I have shared a state tax sheet in my description, along with the IRS federal income tax bracket, so you can see what bracket you would apply for or fall into. But it's in the description if you need it. And overall, that's gonna do it for me. I hope that you learned something new, and if you didn't, I hope that you at least enjoyed watching the video. Comment below your thoughts. I would love the critique as long as it's structured. And yeah, see you on the next one. Follow for more.